The markets are falling, headlines are noisy, and suddenly a familiar question comes up again. What should I do with my SIPs? Should I continue? Should I pause? Or should I cancel altogether? These moments test your behavior more than your portfolios. Let's hear what the experts have to say.
Hello, everyone, and welcome to AtomNomics. Through these conversations, we'll unpack investment ideas that matter in the long run, cutting through noise, headlines, and short-term reactions. As we kick off to this series, systematic investment plans felt like the right place to begin because they reflect a steady, long-term approach to investing rather than reacting to every market move. To explore this, I'm joined by Nandini Priyanka and Vinod Kamat. Thank you both for being here.
Thank you, Yamuna. Happy to be a part of this conversation.
Thanks, Yamuna. Looking forward to it.
On that note, I have some questions for you. Why are SIPs relevant? And why does starting early really matter?
That's a good question, Yamuna. So SIPs are relevant because they bring discipline into investing. Most investors don't struggle with information. What they really struggle with is consistency. So starting early eases the pressure of getting every decision right and allows compounding to work quietly over time. I have an analogy to share here actually. So if you want to enjoy the fruits of a tree, you don't wait for the season. You plant the seed early and give it time to grow.
I agree. SIPs also move the focus away from short-term market movements. The best part about SIP is investors need not time the markets at all. It helps investors to build exposure gradually. This works like magic in the long run.
Absolutely, Vinod. So my next question is, markets are usually volatile. How should investors think about SIPs during ups and downs?
Well, volatility can be uncomfortable, but for SIP investors, it can actually be helpful. So when markets correct, SIPs invest at lower levels. This helps average costs over time. And if investors stay consistent, that is.
Exactly. Let me tell you something. Here, volatility is not the real issue, but the real concern is stopping investments at wrong time. See, there are a lot of data which clearly shows that staying invested through downturn often rewards investors in the long run.
Okay, I think this should help investors from second guessing themselves. Moving on, there are a lot of assumptions around SIPs. What are some common myths that you see?
Common myth is, I would say, a lot of investors get influenced by trends, tips, or what they see on social media. But what really matters is having a simple plan, including the right asset allocation, the right funds, and the most important thing is the patience to stay invested. SIPs work best when you follow a strategy.
Got it, Vinod. So strategy matters more than trends.
Definitely, Yamuna. Another common belief is that SIPs are only for salaried and smaller portfolios. Well, that's not true. SIPs are used across all portfolio sizes. Whether someone is investing smaller amounts or managing a larger corpus, the discipline and staggered investing that a SIP offers works for everyone.
Point well made, Nandini. Think discipline, not investor category, right?
Absolutely.
All right. One last question. Can SIPs help in achieving long-term goals?
Of course, yes. SIPs are fantastic for long-term financial goals. When investors are clear about what they are investing for, that could be their retirement, education, or long-term wealth objectives, they are far more likely to stay invested through market cycles.
And those goals should guide how the money is invested. See, SIPs are just a vehicle, right? But asset allocation and time horizon really determines how effective they are.
Fantastic. I think this really connects all the dots. Before we wrap up, one key takeaways for investors.
If you ask me, consistency matters more than timing, Yamuna. So SIPs rewards patience and long-term thinking.
My takeaway for investors would be stay invested through different market cycles, because wealth is built gradually, not by reacting to the short-term market moves.
Absolutely.
Thank you both for sharing such clear and practical perspectives.
Thank you so much, Yamuna. It was a pleasure.
Thanks, Yamuna.
We look forward to more conversations that shape long-term investing. Thanks everyone for listening. Take care.